Hello class, I'm happy to be with you today. Today we are going to be working some problems from Chapter 5. Now, one of the things that you'll remember that I wrote in your lesson was that we are doing very limited things from Chapter 5. We are only doing the FIFO method of valuing inventory at the end of a period. Okay, and there's a couple reasons why. One is that the world is moving to that. Okay, first in, first out. This is the way most companies actually manage their inventory. We always want to sell the oldest thing on the shelf so it won't get dusty and dirty and lose value. Now, sure, there are some businesses where it makes a lot of sense to use specific identification. Let's think of probably the very best example of this in the world is an automobile dealership. Well, you know, whatever experience you've had buying cars, you probably remember, what does a car have that is unique to them? Well, they have a vehicle identification number, and no two cars are exactly alike, not on a lot. They might be the same color, something's going to be a little different with the options. So when you sell a car, you don't just choose. When you sell a car, you just don't put into cost of goods sold the oldest one. You have to find that exact car in your inventory records and move it to cost of goods sold. Okay, so some businesses do very well with specific identification, but you would be able to figure that out quite handily if you worked at that business. We are going to focus on first in, first out. And the reason is because the whole world is going to first in, first out. By doing the interactive presentation, I know that you have read about and heard about and answered some questions about the other methods. But we are focusing on first in, first out in this class. So the first thing I want to do is work a couple of exercises. And on this particular video, we're going to work exercise 5-3. And if you are looking at your book, which you'll pretty much need to do to follow along with me, whether you're looking at the e-book or the other one. If you're looking at your book, it's on page 247. Okay, so you will see on page 247, we've got a beginning inventory. We've got purchases in a column. So we started out with 140 units. We bought 60 more units. We bought 180. So total, we had 380 units available to sell. Okay? Over here, they tell us that we sold 180 units. Okay? Well, actually, we don't care that they sold them at $15 a piece. What we care about is what is the value of the units that are with us at the end of the year, and what is the value of cost of goods sold. And we've got a couple different ways we can do this, and I'm going to do it two ways. Okay? So in this situation, I've got 380 units were available. Okay? Now, we sold 180 units. So that means we have 200 units left in ending inventory. I need to value those. Okay? So, which units make up these 200? Well, it's the most recent ones that we purchased. First in, first out means that at the end of the period, the most recently purchased items are the ones that we still have. So if you look up here, 180 of this 200 came from the 450 group that were purchased on January 30th. Okay? And that just means that we just need 20 more to get to 200, and they would have come from the January 20th purchase, which we paid $5 for. So the value of our ending inventory is $910. These are dollars. Okay? Now, well, what would cost of goods sold be? I can calculate cost of goods sold two different ways. The first way is that I can go up here and pull off this 1950, because this 1950 goes along with all the units that we started with, 140 plus all the units that we purchased. And so that's my available goods, just like here. Okay? I can subtract the ending inventory of $910. Whatever is left, apparently the difference between those two would be my cost of goods sold. See, $1950 is the total value of all the inventory I had during this period. My ending inventory is $910. So apparently I sold off $1040. Let's check this number doing it the other way. I'm going to go up here to my units sold up above. I sold 100 units. Well, I've got two sales, 100, and I've got a sale of 80 for a total of 180 units. Well, what made up that 100? Well, that whole 100 would have come from the beginning inventory. See, it happened on January 10th. The whole 100 would have come from the beginning inventory. Okay? That'd be 100 at $6. Then, guess what? That leaves me with 40 units left over in beginning inventory. There's still 40 left in beginning inventory. Okay? So then I sold 80. Well, where did those 80 come from? Well, 40 of it is what's left from the beginning inventory. So that's at $6. The other 40 would be from the next batch we bought at $5. Okay, so 40 at $6 would be $240. 40 at $5 would be $200. 0, 4, 6, 2, 2. Looky there. We did it right. So see, either way, I figure my cost of goods sold. I can figure it directly based on each sale and add it up, or I can find it indirectly by solving for the ending inventory and subtracting the ending inventory from the total goods that are available for sale. Okay, great. I'm going to stop here so the video won't get too long, and we'll do another one.